Good evening, everyone. Tonight is September 27th, and my husband Ken and I welcome you to the Hookup with Real Estate call with our very special guest, Jon Sidoti, and we'll get to his introduction in a few minutes. We have to take care of some other business first. And let's go to... Okay, so we offer you a couple of ways in which you can stay connected with us. We have a YouTube channel where tonight's session's replay will end up in a couple of days. And that's at youtube.com/@hookupwithrealestate. We also have a Facebook group. So www.facebook.com/groups/hookupwithrealestate, where you can stay connected. And I'll put these links in the chat later. I did want to point out that you can learn about my journey, our 3 failed partnerships, and how we use debt to basically redeem ourselves from a decade of demise. Oh, Jackie's here. Hey. And so you can read about that on Amazon, or I can send you a signed copy of the book. Either choice is yours. They're actually selling the soft copies on Amazon as well. Ken, would you mind reading this disclaimer, please?
Yes, we appreciate you attending the Hookup with Real Estate Masterclass presented by co-hosts Kenneth and Donna Hook. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Neither Hookup with Real Estate nor its representatives will be liable for any outcomes resulting from the information provided. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you. I also ask you to read the quote of the day.
Quote of the day. No student ever attains eminent success by simply doing what is required. It is the amount of excellence over and above the required that determines greatness. Charles Kendall Adams.
Thank you, Ken. Okay, any questions before I do the introduction? Good. All right, so now we're going on to our special guest, Jon Sidoti, who will be sharing tonight's masterclass on commercial real estate operations, strategies for success. And Jon graduated from Wentworth Institute of Technology in 2012 with a Bachelor's of Science degree in construction management. He has motivation, love, and passion for buildings. And he acquired his first multifamily in 2003 in Quincy, Mass, where he lives. He has expanded his portfolio to own multiple properties in multiple states, contracting with property managers to care for the properties. Jon is an active member in multiple real estate and educational platforms, including the Grant Cardone Platinum Mastermind, the Warrior Group Real Estate Mastermind, and the Bigger Pockets Pro community. Jon started building high-rises with a national general contractor and now looks to build a rental portfolio owning commercial, multifamily, and mixed-use assets. Please help me welcome Jon Sidoti.
Thank you, Donna. Thank you, everybody. Good evening. Donna, how do I share my screen?
On the bottom, there should be a green,
Just-
an up
just
arrow
share
that
it?
says share screen.
Awesome. Let's see. I think so. Can you see? You can
Not,
see that?
it's not yet. Yeah, yep, here we go.
Is that good?
Yes,
Awesome.
it is.
So this is I guess thank you, Donna. Donna kind of ran through my experience in construction, and then kind of getting into the real estate. I'll share my story from the beginning, and I'll just give you the quick and dirty. I started in construction management. You were 10 years before it really all started. I would have been 13 if I started in 03. And
Oh, did I say 03? I meant
you
03.
said 03. So
Sorry,
I
2013.
I started in 2013. I graduated college in 2012. I bought my first duplex in 2013. Lived there, made the right improvements, sold it a few years later, made 1,700%, 1,700% return on my investment
Wow.
on that one deal. One deal. That's where it all started. From there, I got into a commercial asset out of state. I am from Boston, Massachusetts. Massachusetts is not a very landlord friendly state. It is it's difficult to be an owner and operator, a property owner, and make money and be successful in this state. The big guys can do it. They can weather the storms and all that stuff. Little guys, it can get tough. So I owned the duplex. The duplex was great. I sold it, made a bunch of money, got into my first commercial real estate asset in Panama City, Florida. We owned that for just about a month, and we got hit by Hurricane Michael. Hurricane Michael was the strongest hurricane that ever hit the shores of the United States, with sustained winds of over 200 miles an hour. Fortunately, the tenants were okay when that happened, and we made the right improvements off insurance money, got the property back on its feet. We did have to use some investor money to carry us until we got reimbursed by insurance, and now that asset is cash flowing significantly, and we're very fortunate there. In 2021, so my experience when 2013 got the duplex, 2017 sold the duplex, got the commercial in 2018. So within a few years, I got into my first commercial deal. It took a little bit to get started into more commercial, but then I went to a Grant Cardone conference. I met up with the right people, and we started to put together teams. Anything big, anything worth doing is never done by itself. So finding a team that you're that you gel with, that you're in what is it, synchronized with? Is that the word? I think it's the word. And yeah, that is key, because you want a good core team where everyone supports each other, everyone works well together, you all complement each other, and that is going to take you far. So you always want to leverage other people's experiences. You want to complement other people's experiences and their their knowledge, their skills, their, and just kind of scale up, right? If we all scale up, a rising tide raises all ships. So, yeah, then I joined Grant Cardone in 2021, and I met a bunch of people that basically allowed me to get into all these deals. So between Mike Bailey, Tom Verghese, Alex Lovely, Danny Haricki, we just all worked very well together, and we put these deals together, and just got into many markets. So now I tend to think operations is something that I'm very strong, or I'm pretty strong at. So let's that slide. I think that slides in 2. I'm sorry. I'm gonna go out of order here. So the real estate operations, these are some parts of it. I would say these are included but not limited to these items. These are some of the items that I deal with and that we deal with every day. Starting with property acquisition, that's, finding the property, identifying the property, and kind of putting the deal together. Then once you find a deal, you put financing on that deal, which is the debt, right? So you find the deal, then you get financing. Financing can come from a number of different sources, whether it is a debt fund, it could be a local bank, it could be a big bank, it could be insurance companies, it could be, a number of things, and that will be the financing. Once you get your financing, you want to, be talking to property managers, and then with the property manager, you kind of come up with a risk management business plan that you're gonna kind of put to this commercial asset. All commercial assets, or not all, most commercial assets will have a business plan, right? And the banks will require that. The insurance companies will want to see that. So that's kind of what the risk management does. You also want to be doing portfolio diversification. That could be anything from asset class, asset type, tenants, there's a number of ways of diversifying portfolios of real estate, and I have another slide on that, so we'll kind of go through that. Identifying identifying an exit strategy is a big thing in going through your business plan. You want to identify that exit strategy, that you're exiting at the correct time, that if you're exiting or if you're refinancing and giving back capital, you want to be cognizant of how you're doing that. And typically you'll kind of come up with that at the beginning stages when you're developing your business plan. The tax planning, we work with CPAs on all of our tax strategy and tax planning, so that we would defer to a CPA, working with a CPA. Um,
John, do
the
you do when you're putting your business plan together, is the tax planning something you do upfront or all along?
we will identify tax strategy upfront, but then we will also kind of just make sure that everyone gets a benefit from it, because there are certain things in the tax strategy that only certain investors will benefit from. And I would just say I would kind of defer to your CPA and your tax professional on a kind of one-by-one basis. So yeah, that's kind of the tax planning. Investment partnerships, we will do syndications, we'll do joint ventures, depending on the size of the deal, the dynamics of the deal, and kind of how the deal is structured. And that is so that's kind of, I mean, there are a number of ways to partner in real estate, and I would definitely make sure that you know what you're getting into in an investment partnership. A lot of people say it's like a marriage. So yeah. Then documentation and record keeping, that is also an important part of the real estate operations, and we usually team up with the property manager. The property manager will supply documentation, and they will keep records on documentation, and that's something that we'll oversee, and we'll review, documentation for every asset. We have weekly meetings, or not weekly meetings for certain assets. If we're in certain stages, we'll have a plan that, and we're leasing up. We want to meet with the property manager once a week, just to make sure that they're on track, that they're carrying out the business plan efficient and effectively, that they are getting the tenants, that they are signing new tenants, signing people that are qualified, and we want to make sure that we're steering the ship in the direction of our business plan. So that
irritating. So irritating to me.
is there a hot mic? I hope I didn't just mute someone that was trying to talk. But so that's kind of the documentation and record keeping part of it, and that we like to, just make sure that we're reviewing those documents, making sure that we're going in the direction that we stated in the business plan initially. All right, moving on. So diversification. We typically diversify our portfolios with asset class. That would be, A, B, C, or D classes. A is, the brand new buildings, the top of market, you're getting top of market rents, you have the amenities, you're kind of pitching to the higher working class. You're working with a good tenant, stuff like that. You're in the city, you're so those are A class. B class is that's like what 5 to 5 to 20-year-old properties, may have the amenities, but they're a little older, a little more tired. Maybe they're on their second or third owner. So that would be kind of a B class. C class is, it's an older property, 30 years old, 30 to 40 years old. Still may have some amenities, not the amenities that an A or a B will have, but they say C is more for cash flow. A is for the appreciation, B is kind of in the middle, and then the D class are kind of distressed and not a great asset class. We also asset type. There are a number of assets. That's a lot of. So you look at, and we have a slide later that we'll hop to. That is
John,
about
we
the
have
asset.
a question from Isaiah. Do you
Oh,
want me to stop, or do you want to go through this?
yeah, we can stop.
Okay.
Oh, I didn't need you. I just had a quick question, John. You could have answered at the end if you wanted to too. Good to see you, by the way.
Good seeing you, man.
I was gonna ask for the A class asset.
Yes.
For that A class, do you see like cash flow and appreciation? Is it just not strictly appreciation, or can you get, can there be cash flow
So
plays? Okay.
if you buy it right, it can be cash flow and appreciation. A lot of A class assets, because they don't need, like, it's not a heavy lift. You're not doing a lot of work.
Mhm.
You're buying them typically at a lower cap rate,
Mhm.
and that cap rate will kind of translate into what your cash flow is, because the difference between the acquisition cap rate and your debt interest rate is kind of where you're going to be making your money on that margin. Just for a quick reference.
Mhm. Mhm.
So if you're buying at a lower cap rate with that is closer to, or sometimes higher than the debt rate,
Mhm.
your margin is smaller.
Okay.
So you're gonna be that's gonna be more where when you go to sell that asset and you increase the rents to what your business plan says, and
Mhm.
you make that increase, your spread is gonna be bigger when you divide by a smaller cap rate.
Okay.
Does that make sense?
Yeah.
It's an inverted equation, right? So if you're dealing with smaller numbers on like the cap rates, it's gonna be bigger return for you on your exit. So you and I can go through that. Or we can go through that later.
Okay, John. Thank you.
I'm sure Donna can teach that. So I guess back to asset type, there are a number of asset types between multi-family residential, single family residential, multi-tenant industrial, multi single tenant, triple net, big box, plaza, office. All of those are your asset type, and you can diversify between your asset class, your asset type. Self-storage is another good one. Basically the asset type is, great way of diversifying, great way of building great portfolios. The market is another way you can diversify, because at any different at any given time. The different markets are at different sections of kind of the real estate cycle. So while Miami is going through one part of the real estate cycle, Houston, Texas may be on its way up, but Kansas City might be peaking, right? So in Boston, Massachusetts might be on its way down. So in New York City might be at a different part of the real estate cycle. And while it is very difficult to time where exactly in the real estate cycle we are, it's always the best time to be getting into real estate, right, Donna?
Yes, I concur.
So the other diversification ways of diversifying your portfolio is with size. Obviously, the 1-4s, the 1-4s are single family. Those go off your credit. Which I hear they're starting to do loans secured by the property now, for 1-4 family buildings, houses. Also, with commercial assets, you have 5 units and more on the residential side, but then also you have industrial, you have self-storage, you have all that. That goes back to your asset type. And then also your tenant type, the different tenants will be better in different asset classes, asset types, and whatnot there. So let's here we have the asset types, multifamily, residential, multi-tenant, industrial, single tenant, triple net, big box store, shopping plazas, office buildings, malls, and then there's land flips, which is a whole different animal. And then antenna leases, which that's wild. I'm starting to learn a little bit about that. So yeah, I guess and then that was pretty much all I had.
You're muted, Donna.
So I'll ask some questions now. First, does anyone have any questions about John's presentation? Okay.
Did I
So
go
John,
too fast?
where in this cycle do you start thinking about, let's say you're finding a deal.
Can I?
That's
should I-
not so much about the operations per se. Like I consider the operations after the deal closes. Am I wrong about that?
Hold on. Sorry.
Okay. You just want to stop sharing?
Yeah. Should I just stop sharing? All right. Sorry. There we go.
That's all right. So in my mind, and I could be wrong, I view operations like after the deal closes, and then you have all that fun stuff to start with taking
All
over
the
the
moving
property.
parts.
Yeah.
So, really, I consider the operation, the whole process.
Okay.
From because when you think about it, right, you find the deal, you put the plan together, and then you implement the plan. I've always looked at it that it's kind of the whole process. That's all involved in the operations, So
Okay. So let's talk about putting a plan together. Going So going into a property, you're involved in several of them. So tell us a little bit about, how do you know what type of plan to put together for a specific property? And you can give any example that you have.
So when you're finding a property, depending upon the property type, that will kind of steer your business plan to go in a certain direction. Obviously, if it's multifamily, your business plan is going to be very different than single family, which is going to be night and day from an industrial asset on what you can do with that kind of property. So on these assets, the biggest thing is that you want to be increasing rent. In commercial real estate, it's an equation that decides the value of your property, right? So what you want to do is that equation is your net operating income over your cap rate, is the value of your property. So when you increase the net operating income, when you stabilize that net operating income, when you stabilize it, you drive your cap rate down. But also when you increase your net operating income, you increase the value of that property. So basically your main goal is how are you gonna get more money out of this property, right? So that could be you add. Now typically you can't squeeze money out of tenants, whether they're multifamily, single family, industrial, stuff like that. You can't squeeze more money out of them if you're not providing value. Granted, every year as you hold on to the property with inflation, your rents will be increasing naturally. But also your expenses increase naturally. So really, if you want to be turning over tenants and really driving that rent up, which is called forcing appreciation, you have to be providing value to the tenants. So what we typically do on multifamily, we'll try and, maybe it's you add a dog park, maybe it's you put covered parking, maybe it's you add some value to make their lives easier or their living situation better. If it's industrial, we put cameras on site. We'll put a fence or a sliding gate, or we'll put speed bumps in the driveway to like if cars are flying through the parking lot, which this is all stuff that has become an issue at some of our assets today. And or what we do is we get antenna revenue. We'll put an antenna on site, which will increase revenue that way, right? That increases your bottom line. Then or billboards. Billboard revenue is great. So you kind of look for these creative ways.
They're so stupid. I love them.
Sorry about that. So adding those different things will increase your revenue, your net operating income on the property. So
So
Did that
primarily
answer
your
your-
business plan
Yeah.
includes these creative ways to
increase your gross income, decrease your expenses, and stabilize the asset. And stabilizing is a lot through signing leases, signing annual leases, whatever lease kind of works for that asset class and type. And
Okay.
so,
So what are the components of a business plan then? Besides this part, anything else we should know about? What's it?
so
Somebody asked a question. Hold on. Let me
yeah.
see. How long does it take to stabilize a property?
So initially, when you first take over a property, it's typically 6 months is a rule of thumb that operators will tell the investors. It takes 6 months to stabilize, and then at that 6-month mark, the operators will be assessing and potentially giving a distribution or something to that effect. But then, at any point in the deal, you may have to stabilize for some reason. If you shouldn't really have a big move out of tenants if you're doing all the right things at the asset, but you may have to go through something if there's a weather event that happens in the area, if if for any given reason, a disaster, COVID, anything could cause people to move out of a property, a death, where you may have to stabilize and you may have to go into a stabilization period. And as an operator, you just have to be able to recognize it, know how to get through it, and kind of continue moving on, because things do happen. So
Yeah, interesting. So, I mean, obviously, weather conditions are easy to recognize, death is easy to recognize, but something like COVID probably wasn't so easy to recognize.
yeah, right.
Um,
So, but
but
I mean, there are always curveballs in real estate. I think either way, real estate is safe. It's predictable, for the most part, and you're especially, the more units, the better you are, right?
less risk.
Less risk. But I mean, what happens if? I mean, I looked at a deal. Oh God, probably 12 years ago, that it was 410 units, and one pipe burst in the parking lot. Temperatures got dangerously cold, one pipe burst, and there was one shut-off valve to the whole building.
Oh,
And because it was cold for such a prolonged period of time, that one pipe that burst flooded the parking lot. It turned into ice. They were unable to dig and repair that one pipe, so they shut off all the water to the entire building.
sounds
And
pretty
then,
painful.
because it was so cold for so long, everyone started moving out. Now, the owner of this building was in Europe, so he had no idea what was going on. And all of a sudden, his buildings next to vacant, I mean that's not good.
No, I'd say not.
Not a good
But
operator.
and like that's something that could easily be avoided, you know. But
So
you
how
know,
much do you like, inspect the property and you're like, okay, this needs a value add, that needs a value add versus like, how do you weigh what you're gonna fix versus how much you have to raise? You know what I mean?
so like on a property when you're acquiring it, how do you identify what to fix and like in what order?
Yeah, like what
Yeah,
will
that would
bring
be
the,
part of your business plan is to evaluate all that, correct?
Yeah.
right, I
So
mean, you can't fix everything, let's say. You have to pick and choose based on the
yeah,
money, based on the funds you have or the funds you're gonna raise. So,
yeah, and
go ahead.
that will be a lot of that will be, what's gonna provide the most value to the tenants, what's gonna drive the value in the asset the most. Where do you get the most value out of that being in your business plan? With respect to how much that it's gonna cost you as the operator. Um, so that's kind of like a cost. Um, that's kind of like cost planning, and you want to just make sure that you're gonna what you're putting into it, you're also gonna get out of it. And you just kind of weigh and you stay cognizant of that.
Okay,
So
gotta do a risk reward analysis,
yeah,
basically.
risk reward.
Uh, So tell us about, as an operator, you have to find and deal with property managers. So tell us about that, and if you
Yeah.
have any examples.
So I love dealing with property managers. They otherwise you wouldn't be able to be everywhere, right?
Mhm.
Or at least own all these different assets all over the place. But you want to really kind of focus in on good property managers, and a lot of I use referrals, reviews, to kind of vet out the property managers, and then I have calls with the property manager, and it's not, the first call, oh, you're hired. You want to bring them on board when you're uh working through when you're kind of implement you're designing your business plan, because they're going to be an integral piece of it. They're going to be the ones carrying out the business plan. They're going to be ones driving the rents. They're going to be the ones with the knowledge of the market. You want to really make sure that your business plan is feasible and will be effective, and um, you'll be able to get out what you're planning on getting out of it. If we add this, we'll be able to get this kind of rent increase for the dog park or the pool or the ice skating rink or whatever you add to the property. You want to make sure that it's feasible, and property managers will be able to give you that kind of direction. Now the so I go off a lot of referrals to get to the property manager if I don't already have a relationship or previous knowledge of someone to go to. But you know, um, so identify property managers that way, talk to them, meet with them again, talk to them, and then just kind of team up with them. I mean, at the end of the day, they're on your team. So you want to treat them well. You know, they're working with you, and they benefit just as much as you benefit when that asset succeeds.
So are there any like specific questions that you find particularly useful in vetting out a property manager?
How are you going to implement this?
Okay,
Um,
how would
you
you
know,
implement?
what would you, and then just you want to know their local, what are they gonna do to get tenants? What's their vetting process of the tenant? What do they do? Credit reports? Do they do background checks? And what's included in my property management fee, and what's not included, and what can if I need this done, are you going to be able to go by? If I need, if we're at insurance time, typically when you're renewing your insurance, um you get a bunch of requests from the insurance agents. You have to do A, B, and C, to update the property if you're not keeping up with everything, or if something happens, and the insurance company may ask for 5 different things, and is the property manager going to be able to answer their phone? Are they going to be able to go out there? Are they going to be able to deliver keys for inspections? So that is and you just want to know that they're going to be able to work with you, talk to you, do that. And I know on a lot of industrial property, which I've been burned on this in the past, is collecting rents. Some property managers won't even collect the rent for you. And we didn't even know that. We were like, isn't that what we're paying you? And they're like, no, they should know that they have to pay their rent. So and I was like, so what do you do? And they were like, well, on the 10th day, if they haven't paid their rent, we give them an eviction notice. And then 5 days after that, we'll evict them. We'll go to court. And I was like, we don't want to be evicting people. We want people paying. So work with the property manager, or work with the tenants. And I mean, this guy was a total dud. And we just, but having the knowledge and being able to see that and make that correction quick is important in that situation, right? So
Yeah.
I don't know. That was just one story that came to mind there.
Well,
That you know what you
Definitely
get,
be able to
right?
do evictions in a week in Massachusetts. That's for sure.
Yeah, I know, right?
um, so then, so you find out some surprises with your property manager, but like, how do you maintain the relationship with your property manager?
I mean, you wanna stay in touch with them. You wanna be quick to get back to them. You wanna, I mean, we're all people, right? It's a partnership, and we try and look out for each other's best interests, and you know, treat them just like you would want to be treated, and kind of, I don't know.
Yeah, no, I
So
get it. So, but do you meet with them regularly? Like, yeah.
yeah, so I guess to set anyone up for success, right? You want to make sure that you're communicating um with them, but then also that they know the plan that you communicate the plan to them, and that everything's working okay. So that everyone is successful in what they're doing. So we usually meet with property managers at least once a month. Like I said early on, we meet with the, like, if we're kind of stabilized, we meet with the property manager once a month just to make sure, rent collections are going well. Rent collections, complaints, maintenance, everything at the asset is going well. And if there is anything for us, I always try and make it clear that, I'm available whenever they need me, and just call me, text me, email
Right,
me.
so that's cool. So we're gonna shift over toward investor relations because that's part of operations as well.
Yes.
So tell us,
Investor relations is key, because your investors want to know what is going on, and communicating effectively with your investors is, I mean, in reality, as an operator, we work for our investors. We, our job is to make money for the investor, right? Otherwise, it wouldn't be possible for us to be an operator. For the Grant Cardones, the Rod Queeps, the all those, the Jake and Gino, all the big gurus, they need investors. Otherwise, they don't have, they're not able to buy the big assets that we get to buy. So communicating with the investors, keeping them in tune with what's going on, all that, so what we do, part of the teams that I'm on, is we will create a schedule at the beginning of the year, right? You're gonna get email communication once a month, and the email communication is gonna kind of update them on everything going on at the property. Once a quarter, we're gonna do a Zoom call where we're just gonna run through everything at the asset, everything that's been going on for the past quarter, the last 3 months. We're gonna run through all that, and then we'll also tell them that we're gonna distribute on, by the middle of the month of this month. And that is something we want to set expectations up front. So we create these schedules and we put them every month in the email distributions. And that way everyone can kind of refer to it, and that way they know what's going on and they know what to expect. So that's one thing in investor relations that I try and push with all my teams, all the teams that I'm on. I think that's pretty important. So
that is pretty important. So let's talk about the distributions. So if you're, I mean, I know you have deals that went well and some that haven't done as well. So how do you manage distribution when, they're less than regular?
So typically, we started off doing quarterly distributions. So that's every 3 months we do a distribution. Typically it's February, May, August, and November. were the quarterly distributions. And then that's typical for a lot of investments. Some investments will do monthly distributions, and we're actually getting into some monthly distributions on some assets. And we communicated effectively. Like if when we are able to give the distributions, we after stabilization will give a distribution, send out an email, and or send out the email and then give the distribution.
But who
Um,
manages your distributions? Like, is that taken care of by a tool or
So
CPA?
depending on the asset and depending on the platform, like I mean there are a number of platforms that people use out there, whether it's Syndication Pro, Cashflow Portal, TribeVest, or what, and then there are a number of them. They're all different, and I know some are easier than others. But the TribeVest, we have an Excel spreadsheet that we a lot of it is done in Excel, and we'll just create it that way. If it's in TribeVest, if it's in Cashflow Portal, you're tied to a certain amount of equity, and then you put in how much you're distributing, and then it automatically calculates what the distribution is that goes to the investor, driven by how much they have invested and what their percentage of the deal is. So yeah.
Okay.
Pretty cool. The different systems are it's cool.
Yeah. Do you have a preference?
Right now I'm liking Cashflow Portal.
Okay.
It's super easy. You put in how much you have for distribution, and then it spits out, and that actually allows us to do every month. TribeVest is a little more difficult. You have to manually or not manually, but you have to figure it out. You have to calculate it and then put it into each different investor.
Yes, it's
So
more.
with the bigger teams, it's not as good.
Okay.
It's a lot of work for bigger teams, if that makes sense.
Yeah, no, it definitely does. Now, okay, so distributions, they're calculated and then they get mailed out or direct deposit, I guess, depending on
Yeah.
how that's.
We do a lot of ACH deposits,
Okay.
which get sent and just show up in your bank account. Pretty cool.
Yeah. So, I know you're considering doing an exit of a property. You haven't done it on the couple of them that we've talked about recently, but when it comes to thinking about exiting, what can you tell us from an operations point of view?
Yeah, absolutely. So exiting a property is it's a big thing. A lot of it is you have these business plans that I referred to at the beginning. Once you've implemented the business plan, you can stay in the deal for cash flow, or what you can do is you can exit it, right? And then when you exit it, you're able to go on and buy something that will allow you to grow more, right? Whether that, I mean, you can go from like I did the duplex to 12 unit, and then the 12 unit to 20 units, and then 20 units to 42 units, and 42 to 170 or bigger, and it allows you to grow. So when you get the chance and the opportunity to kind of turn a deal, exit a deal, and move on to something bigger, better, that will allow you to grow more in the different markets, in the different asset classes, in the different asset types, learn more about yourself, learn more about a team, learn more about other teams, put money into some other. I mean, in reality, you're not able to access a lot of the equity that you have in a deal until you sell it, right? So, and that's the beautiful thing about exiting deals, is you get rewarded for what you've done and what the deal has done and the market that you invested in, and then there are a number of ways to take money out. So, definitely don't go and pay the tax though. Whether you do a 1031 exchange, whether you do a hard money loan and take money out just before the close, there are a number of ways that you can benefit and realize the appreciation and get the cash out and kind of build your wealth. So
I know
it's fun.
you're considering that for a couple of properties, but that's a really positive sign that you were able to execute your business plan. And
Yeah.
Yeah.
And, I mean, some deals we've been in for just under 2 years, and we're already talking about a 3x gain, a 300%. So, or I guess it's a 400% because you get your money back too. So,
that's awesome.
yeah.
So in terms of, some of your properties aren't where you live. So I know you're using property managers and things, but what's any tips or tricks on how to manage from afar?
So, the world is not that big anymore. The country is not that big. I mean, you can get anywhere in the United States, and for the most part, you can get anywhere in about 6 hours. And the reality is you don't have to be with Zoom, with Google Maps, with face chat, with all the different tools today. You do not have to be boots on the ground. You can, that's, I mean, property managers, leasing agents. We have an asset in Shreveport, Louisiana that I've been to twice. I've been there twice, and we've owned it for 2 years, and we got hit by a tornado, and we bought it, and we have an asset in Panama City, Florida that we bought in 2018 that I've been to once, and that got hit by a hurricane. And I mean, there's you can always hire people. You can hire people to be on your team and be you when you're not there. So we leverage other people's expertise and other people's market knowledge, and you know, it that's what drives economies, right?
That's true.
So, but also one of the best things about being able to invest out of state is, you know, you won't all over well, I enjoy traveling, and you know, you can travel, you can make all sorts of different impacts. You get to experience different cultures, and that's all fun.
And it's all a business write-off on that.
It definitely can be.
If you're going to look at properties, I mean,
Yeah. So it's
all right, I know I've asked a lot of questions. Somebody here must have another question. Ken, how about you?
Yeah, I do. Have you ever done, I hear them talking about like a cash out refi. Have you done that?
we have not done the cash out refi yet. However, a cash out refi is simply just putting new debt on the asset and taking money out to pay back investors, pay off debt. Like if you have work that you want to do, you do a cash out refi, pull equity out of that deal, and then either give money back to the investors or, you know, use it to upgrade the property.
So the question I have, part two to that is, so when you do that, you want to make sure you're not like pulling it all out, so then your rents don't even cover the debt, correct? Is there like a certain ratio you use for that,
So
or?
that will primarily be driven by the bank. The bank
Okay.
will not allow you to take out a loan against the property that puts you underwater, right?
Gotcha. Okay.
So typically for commercial assets, you need 1.2 to 1.25 debt coverage, which means basically you have 25% over your debt payment every month.
Okay.
So in banks, most recently have gotten more strict about that, looking for 35, sometimes 40%. So
Okay.
I have a question.
sure.
Hey John, so I've heard investors talk about something like uh options for in regards to commercial real estate. Is that something that's relevant? I don't know. I've heard of like options for like stock trading, but like I don't know. I've heard it in the context of
Yeah.
commercial.
So I think I kind of know what you're talking about, but options are basically, it's like an option to buy this. I think it's like people just say, I want an option to buy this property. I don't know, Donna, do you know much
Uh,
about options?
I mean, there's lease options, so the renter can come up with a payment, a certain fixed payment, and then that part of that money will go toward the purchasing of the property, but not as familiar in multifamily than single family. So had you heard it, Isaiah, in multifamily or single family?
I heard it in commercial. I only heard it in like large commercial projects. I wasn't too familiar with it either, so I don't know.
Sorry,
I'll have to
If
look
you're
into
talking
that.
about, for instance, REITs, yes, you could do an option on a REIT because
Mhm.
that is a security.
Okay. Okay.
Yeah, it's publicly traded. Yeah. Mhm.
Okay. Okay.
thanks, Karen.
Thank you guys.
Who else has questions? Karen, you have any questions for John?
John, how long have you been doing commercial, how long have you been in business doing commercial real estate?
I've been doing commercial since 2018, so 5 years. But real estate as a whole since about 10 years ago. And before that, I was building the big buildings that I'm now buying.
What made you decide to get into real estate in the first place?
I just bought a duplex, and I was living in half and renting out the other half.
Perfect tax situation. Great job.
Yeah, and then it just kind of, that opened my eyes, and then, you see everything, all the good that can come from real estate, whether you're helping people, giving people a place to live, or you're giving a spot for businesses to grow and flourish and kind of drive this incredible economy that we're in. And but then all the benefits of working with all the different people that you work with on a day-to-day basis, and all the, I don't know, I see a lot of smiles every day, and that it's just so rewarding, so
Well, that's much more rewarding than NOI.
totally.
It's not really all about the numbers, even though it is. It's all about the people, right, John?
I enjoy seeing people, working with people, so
Great. Jason, how about you?
Hey, how you doing?
what's going
John,
on,
good to
Jason?
see you, man. How you
Good
doing?
seeing you. Great.
Uh,
You?
I can really relate to the people are important. Like I was talking to someone today about property management, and this, I don't know, I think the deal they were looking at was like 50 units, somewhere around there, and they were talking about property management, and we got on that conversation, and it was like, your tenants are where the money comes from. And you're going to need communication between, the operator and the tenants, and that's going to be your property management. So you want to have a big enough property with enough income that you can support a full-time management staff. It doesn't have to be a lot of staff, but it needs to be full-time. They need to be capable, and they need to be competent. They need to be able to talk to your tenants, communicate with the tenants, and keep the turnover down. And you need to be able to also, in turn, those tenants that they're taking care of are paying the bill. They're paying the salary for your property manager because they're getting paid off of how much rent actually comes in.
Yeah.
And it was just kind of like a light bulb. It was like the property is an asset, and the property is what you buy, but the tenants are the real asset there. It's once again, it's people and it's relationships.
Yeah.
And I just thought that
tenants
was
drive it. I mean, it's there are a lot of moving parts, and obviously you have the asset side, right? There's the asset that needs, you have to pay attention to that. You can't neglect the asset. You can't neglect the tenant because they're what makes the asset work. But
yes.
then you also have the investor side, and you can't neglect the investor because then you're not going to have the asset. So you can't have
Right.
one without the other. And you gotta kind of, I mean, essentially, I never really thought of this. You're a clown juggling. You're juggling three balls.
And you got to keep them all up. The deal, the
You got-
debt, and the equity. You have to have them all.
The deal, the debt, the equity, right? And then the asset, the tenant, and the investor. You know, it's all of it. So
Yeah.
but
Got all the plates spinning.
yeah,
John's a master multitasker, just saying.
it's enough to make your head spin. So
For
Especially
sure.
when you got so many properties are operating. So how do you do that juggling act with so many properties, John?
I just have fun. I call it we continue making the music, right? We rock and roll all day long. So
Love it.
if there's one book that I can recommend, do you ask this at the end?
Sure, you can tell me. Tell us.
No, just we'll wait till the end, but
Okay,
we'll get there then. So
right. Jackie, how about you? Do you have any questions?
I have comments. I'm really new to this. I'm completely green. And the one thing that I want to say, first of all, John, you did a really great job of organizing and making sense out of things, which is how I learned the best. So thank you for that. And the way you very intentionally described and explained each topic, again, it's educating me as a new person. But the thing that I really want to share is exactly what you just, very last thing that you've been showing, is that it's not just an asset, it is the people. And that just completely gave me a whole different paradigm shift to realize why that this, it is fun. And it's a win-win for everyone. And when you think about, if you're providing a great asset, taking care for it, honoring the people that are supporting that venture, and realize that, I was just thinking about that. If I was a person that was a tenant, to have a safe place to stay, place that's taken care of, that would take a lot of stress off of me.
Yeah.
So I was like putting a different hat on. And so I'm grateful that you brought that up, because it really is very helpful to see that side of it. And certainly is going to make a difference for me. So thank you. Really, thank you. It's awesome.
thanks, Jackie.
Thanks, Jackie. Nate, by any chance, do you have questions? Are you there? Okay.
Yes. Can you explain a little bit on how Section 8 works? Can I ask that question?
Is that so I am not 100% sure on Section 8.
Ken can talk about it.
Yeah, I've had Section 8. Typically, it's depending upon the amount that the tenant is approved, they would get a voucher. Like it could be for the whole month's rent, or it could be a portion of the rent. And basically, the money comes from the government. So they have to be approved for that size space. Because, like a good example, we had a Section 8 tenant, and unfortunately, one of her children passed away. So she no longer qualified for that size house. So she had to move. So they do have criteria. They do come in and inspect the property. Also, my brother has a Section 8, and they usually inspect the property on an annual basis to make sure it meets the guidelines of the Section 8 program. So typically the tenants, they realize that if they don't maintain the property in a certain regard for the property, they could be taken out of the program. So, a lot of them know that. So they, you're always going to have some people who abuse privileges, but the majority of them, granted, they are lower income people. So, that this is a program that helps them. So.
I'm looking at a 24 unit up in Georgia. And they have 7 of them are already Section 8s, and they were, now I'm not sure if the rest of them were already signed up for Section 8 or what, but they said they were going to be turning them over to Section 8, and they get $11.60 a month.
Well, I know here in New Jersey, okay, you cannot discriminate against anybody. It's considered their source of income. You cannot say, I don't take Section 8. It's against the law here. So no matter what their source of income, the only thing you could actually not allow a tenant is their credit. That's the only
Background check.
Well, excuse me, background checks and credit. If they do have like a criminal record or stuff like that, or they have bad credit, you could what's the word? Not rent to them. But as far as source of income, Section 8 is not, you don't have a choice. In New Jersey, that is. I don't know how every other state is, but I know in New Jersey, you have to rent to them. If they qualify to rent your unit, you have no choice but to rent to them. So
Do you like Section 8s?
I haven't had any in a while. Most of mine have been people who have jobs and don't have Section 8. But my brother loves it because he says he knows he's going to get his check every month. And I was actually the realtor that helped him find the tenant, and he's had them now there for 3, maybe going on 4 years. And every time I talk to him, he loves it. He says, I never have to worry about where my checks come from. So.
Huh.
So.
Okay. Thank
And they
you.
will do asbestos checking in the property.
Well, they check all kinds of stuff. Yeah.
But I think when we had Section 8, it was the easiest tenant we had. You know?
Yeah, we knew we got the check every month. A lot of the other ones we had, we wound up having to go to court to evict them. So,
Yeah.
but our house is actually, the one house is probably in a D neighborhood. So it's just a bad area of the neighborhood. So.
Okay, well, thank you very much. And thank
You're
you, John, for presenting this tonight.
Do you have
Very
any
interesting.
operations questions?
No, I'm good. Thank you.
Okay. All right. I had thought of one more. I'm trying to think of what it was now. I kind of came and went. So in terms of, so it's kind of the whole picture. So you think of operations from the very beginning, finding the deal to the exit.
Yeah.
And what about CapEx? Like, how do you make any special determination when you have CapEx to consider?
I mean, you always want to look at any CapEx that may have to be done on site. Just because you want to budget it, but like if you see a roof that has to be replaced, or if you see a parking lot that has to be replaced, that's all something that you'd want to budget up front.
Okay.
Budget up front, or budget something in the middle of the project, or you want to budget those things rather than getting halfway through your business plan and all of a sudden you have a $400,000 expense to replace a parking lot. That's not good.
No good. So you got a plan.
No.
All right. So we're just
Okay.
about, what's that?
Another question on CapEx. If you're purchasing a place, can you ask for their CapEx?
They'll usually give that information to you, but you wanna know about deferred maintenance. You wanna know, what are some of the CapEx items that you have coming up. And those are just questions that you wanna ask. So,
Okay, thank you.
Well, like I said, we're just coming up on the end here. So you had a book recommendation.
I do have a book recommendation. It is my favorite book that I ever probably read is Am I Being Too Subtle by Sam Zell. And I would get the audio version because it's told by Sam Zell himself. And Sam Zell passed away a couple months ago. And if you don't know who Sam Zell is, he basically he was a billionaire. He was basically the founding father of our REIT structure, and but he was a Polish immigrant, started as a a normal everyday person selling magazines, actually selling a Playboy magazine.
He must
and
have gotten rich off of that then, right?
oh yeah, in Chicago, right? But you can read the story. They're listening to the audiobook. It's told by Sam Zell himself, and definitely Am I Being Too Subtle by Sam Zell. Highly recommended. Incredible story. Talks about kind of his story, everything he's done, he's gotten into, how he did it. Great guy. Highly recommend the book. My favorite book.
Awesome. That's so awesome.
Uh,
Well, any last tips, advice before we depart?
Go big or go bigger. Find something. Find something that is gonna make you excited. Find something that will, the pride of ownership, buying, reach out of your comfort zone. I'm a big
You think?
I'm
As I'm
all
holding
about
on to
that.
half my face.
So just make it happen and have fun while you're doing it. So
Right.
Thank you, John, man.
absolutely.
Yeah.
guys, yeah.
Thank you so
Thank you.
much.
Thank
This
you.
is really awesome.
Thanks a lot.
I wanna take a quick minute to thank Donna and Ken for allowing me to come on to this awesome Zoom and be a part of this great community. I really recommend the real estate book that you guys sent me, the women real estate book. I think there's a lot to learn from Donna and Ken's story
Oh,
in that
Jackie
book.
has one too.
So, but
Thank you, John.
thank you again, and thank you for letting me, share my story here. So,
Thank you for
Alright,
coming.
It was really awesome
Thanks,
to have you. All right.
thank
Have
you.
fun.
Good
We'll
night.
see you
Thank
guys
you,
soon.
everybody.
Good
Have a
night,
good night.
everyone.
I
Have a good evening. Thank you.